Hey, Steve Saretsky here. As always, this is Canadian real estate market update with a particular focus on Vancouver. If you're getting sort of value entertainment out of these videos, all it asks is that you hit thumbs up and subscribe. Questions, comments, put those below. Bit of a slower news week, so I'll probably keep this video short. But obviously, big happenings here. The calendar has obviously been replaced behind me with a picture and quote that I kind of feel is indicative of financial markets, the macro environment, and in particular the Vancouver housing market, which basically reads, "Smooth seas never made a skilled sailor," and I think that's sort of reflective of the conditions that we're entering. Obviously, the next couple of years seem to be more volatile, and but I think also bring tremendous amounts of opportunity to those who are prepared. Getting into it. Actually attended a private real estate equity investment conference earlier this week. Some very smart people there networking, and they had sort of basically like a keynote slash fireside chat with I'd argue some pretty successful people that have built their success in the real estate space. And it wasn't surprising. It was generally a bullish narrative, but I did just sitting there. Obviously, I think I have a very much different contrarian viewpoint. So by all means, I'm not correct. But some interesting things that I think that were brought up that I didn't necessarily agree with. And again, it's to each their own opinion. I have to respect where these people are coming from, but. I think one of the aspects was talking about the Vancouver real estate market, that it wasn't necessarily as bad as the media is reporting, and that the demand, all we've done with these housing policies, with the stress test, foreign buyers tax, speculation tax, etc., all you've done is suppress demand, and sort of their theory was that this demand would basically be temporarily withheld and then just unleashed into the market at some future date. But I think that what's important to understand is I think that unfortunately a lot of these guys don't necessarily understand how the banking system works, and monetary policy, etc. Is that we have to also ask ourselves, while that might be true, you are suppressing demand. What ultimately drives demand, and how much of that demand that we've had over the last couple of years was nothing short of temporary. It was essentially dealing with funny money. I mean, over the last 10 years, if we want to talk about demand, this demand that we had over the last couple of years, how much of it was real demand and how much of it was demand that was driven by a decade of historically low interest rates, accommodative monetary policy, a money supply that has grown exponentially. You had the single largest credit expansion in history coming out of China over the last number of years, and all that funny money where these guys basically started up a printing press and created an egregious amount of money out of thin air. That money exited the country en masse in 2015 and 2016 and flooded not just into Vancouver real estate, but into global property markets. Looking for a safe haven, a hedge. You've created all this money. It's got to flow somewhere, and that money flooded out. And again, is that real demand, or is that just sort of you've created this literally once in a lifetime credit creation? You literally have the single largest credit expansion in history. So again, how much of that was driven, and then obviously as that money came out, we had this environment that was the Bank of Canada had basically planted the seeds for speculation. When you leave interest rates that low, when the cost of money, 5-year fixed was 2.39%. It's basically the cost of inflation. They're basically giving you this money away. Naturally, it's going to increase the demand, and obviously higher prices beget higher prices, increasing speculation, creating a positive feedback loop. So I think over the last couple of years, you've had this, unnatural amount of demand. And I think now with these policies and obviously the tighter credit conditions, you're actually getting back into a more normal, realistic amount of demand that isn't driven by speculation, isn't driven by just ridiculously crazy monetary policy. So I think that's one of the things that I personally, again, people can feel free to disagree with that, but I don't see these policies as temporarily holding back demand. I think that a lot of the demand, if you understand, I think financial markets, I mean, there's so many books that you can read on this, go back and study history, but this just creates this positive feedback loop where higher prices, a growing real estate market begets more jobs, construction growth, etc., and that just pummels in more immigration as people come here looking for prosperity, right? More jobs, higher wages, etc., because one man's spending is another man's income. So you get higher real estate prices, which in turn creates a wealth effect, which means people start to spend more, etc., and that's really all created by this crazy environment that was laid out from central banks over the last couple of years. So again, that was sort of my take on it. Certainly to each their own. But looking at today's market, the Bank of Canada again released their update on the mortgage stress test in the second quarter of 2018, showing that new uninsured mortgages, the percentage of those mortgages which had a loan to income of 450% or more, which is basically 4.5x your income, has been steadily declining across all property markets. That's really a result of basically, I don't think this risk, the Bank of Canada was talking about the risk basically, slowing down or starting to disappear, but I don't think it has. I think it's actually shifted into the private lending space where, because of these stress tests, they're actually getting pushed into sort of these shorter term 1-year loans at a higher interest rate. And the Bank of Canada and CMHC doesn't even actually have any real data on private lenders. They're actually only making estimates. And I think the Bank of Canada released an estimate that they thought private lending was making up about 9% of total mortgage issuance in the greater Toronto area. But I think it's much higher. Obviously, we had data a couple weeks back that showed 20% of mortgage refinances in the second quarter of 2018 came from the private lending space. I think it was up from 13%. So you've had 20% of refinances going through the private lending channel. I think is huge, and that's obviously you might have de-risked the banks, which I think was the OSFI's ultimate goal, was that basically they know where the household indebtedness lies. They know the interest rates are moving up. They know that at some point it's inevitable these households deleverage. And this can't continue on forever, so they're basically de-risking the banks while they can, and they're basically passing the hot potato onto the private lenders who are basically under the assumption that they're making risk-free loans, but I think again these shorter-term duration loans with a higher interest rate in an environment where house prices are starting to decline actually creates more risk, but perhaps outside of the federally regulated institutions. And of course, we've seen them now, as I mentioned in my video last week, clamping down on home equity lines of credit, which have been a huge boost and growth component of private lenders, where basically people tap your home equity line of credit at say 4.5% and lend it out to these private lenders at 9%, and basically take that spread. So that's pretty much it. And I mean, it's just, again, going back to that, the whole thought process, 'cause I keep hearing this again from multiple developers and people saying, these stress tests, you're just temporarily suppressing the demand. Well, and obviously people are upset about, you're telling Canadians they can't be borrowing more. This is so restrictive, but I think people are really underestimating that, again, Canada has the most indebted household in the G7, and you've created this where you have debt to disposable income of 170%. clearly there's been borrowing. There's been a lot of borrowing, and the government has been very accommodative and very encouraging of people to borrow. They've implemented policies to encourage households to borrow, not only with low interest rates, but I think that the bank lending has been more than generous. In 2008, people have to understand, well, why did Canadian housing not roll over in 2008? There was demand policies put in place to continue to allow borrowing. So you had in 2008, $69 billion of mortgages were securitized by CMHC, which was basically 90% of the mortgages that year were securitized. And offloaded from the bank's balance sheet. So basically, they were allowing banks what they wanted to do because they didn't want the economy to basically roll over like it was in the United States and much of the world. They wanted to say, okay, well, we have to encourage the banks to keep lending. And so in order to do that, they basically said, okay, you guys keep issuing new mortgages, issuing new loans, and we will basically securitize all of them. So we'll get them off your balance sheet so there's no risk to you. You basically create the loan, we will securitize it, take it off your balance sheet, insure it, and then sell it to a pension fund in Europe or something, because obviously the Canadian government, CMHC, is insuring these mortgages. So that is a massive stimulus, which again I would argue just kicked the can down the road. But if we want to talk about artificially suppressing demand, I think we also need to talk about artificially pumping demand, and I think that's what's really been going on in this Canadian bull market. Over the last, almost 20 years now. So, and I think that's interesting to see that the regulators now are taking a complete different stance. As opposed to providing stimulus, they're removing the stimulus in the forms of stress tests, pulling back on home equity lines of credit. You now have CMHC has dramatically slowed their issuance of insured mortgages. That has fallen quite a bit. So CMHC is curtailing their risk. OSFI is curtailing the risk of the big banks. And then you have governments which are generally supportive of housing, offering home buyer grants, GST rebates, etc. Now they're saying, okay, well, we actually want more affordable housing. People voted for affordable housing, so we're going to implement foreign buyers tax, speculation tax, empty homes tax. They're actually, as opposed to trying to prop up the values of real estate, they're actually basically have come out and said we're trying to push the values down. So you basically have all these regulators taking much different stances. So it's interesting to see the mindsets of basically governments and regulators that have generally been supportive of the market are now in complete opposite, and so it's a much different landscape. We'll continue to keep an eye on things, but really not much whole from a news perspective this week, so just wanted to sort of touch on that, give a little rant. We'll keep an eye on the November numbers, which will release the next little week or so. So other than that, hope that helped. I'll see you next week.